Hi, everybody. Good afternoon. Sarah Springer here, broker owner of Pathways Realty. I welcome you to this video chat session that I'm going to be having with Robert Barnett today. Thank you so much for tuning in, and we hope what we're going to share with you today will be insightful, educational, and beneficial to you. Take care. Hi, and welcome back. We are continuing on with our conversation. Sarah Springer here with Pathways Realty in Tallahassee, Florida, and I'm meeting with Robert Barnett, who is a loan officer with Loan Depot here. Loan Depot is also a national company, so feel free to reach out to him. He is a great resource and a great loan officer. I've had many good experiences with him over the years. So one of the last things that I wanted to talk with you about, Robert, is giving some guidance and advice to those people who are out there who already have their loans, already in their homes, and who are experiencing some of the unfortunate fallout of this COVID virus with either temporary or permanent layoffs and unemployment. I know there's a bit of panic out there. I know that there's discussion with the stimulus and things like that of figuring out how to give some temporary relief on mortgage payments for borrowers. Where do they go and how do they know what to do to make sure that they don't inadvertently fall behind and get into that situation where the trigger is met that begins processing them being in default? What do owners do now?
And thank you for asking this question, because I've been receiving a lot of phone calls specifically about where do I go, what do I do, what resources are out there. And the first thing you should do is immediately call whomever's servicing your mortgage. Whoever you're making your mortgage payments to, that's got to be your first call. You need to talk with someone in customer service, possibly even in the collections department, and let them know what you're going through so that you can get the ball rolling. I tell people at this time, you need to also plan to have some longer hold times, because there's a lot of people in a similar situation. And again, the resources that are available with most loan servicers, they're already being stretched very thin regarding this. So please have some patience trying to get through this.
The servicers would be found on the statement that's provided as to where the payment is being sent. Not all institutions keep the servicing. Many of them, it gets transferred out as the mortgages get sold. That's the 800 number that you would be calling, correct?
That is correct. Yes, that's who should be your first call. The big thing that you should be expecting is a forbearance request. This is where they're going to put a pause on your monthly payments and then move them out. Probably only about 90 days is probably the max of what most lenders out there are going to do to start. But what happens is at the end of that initial forbearance or deferral period, all of your payments that you've deferred will be due. Forbearance is not forgiveness. So you will still have to make those monthly payments and get them caught up. Now, if it's a scenario where 90 days comes up and you're not in any of a better situation, at that time, you pretty much would have to just re-up with the mortgage servicer and see if they can give you an additional extension. The mortgage servicer is really not going to do anything permanent until they have a confirmation that you are back on solid ground. If you've been laid off or furloughed, they're going to want to see that you're back to work, that things are starting to return to normal. And then at that point, what they may look to do is offer you a loan modification offer. That's where they're going to take whatever the current amount is that's owed, modify the loan to extend out the term. They'll probably keep your interest rate the same. That's what we saw a lot of during the recession. And so most loan servicers still have some mechanism in place to be able to go through loan modification processes. But the important thing is, if you know before the end of the forbearance period that your situation has not improved, you really need to get the ball rolling on trying to get that process moved forward, because we're only going to be looking for the jobless claims to increase over the next upcoming weeks and months.
So you mentioned loan modification, and so to be clear on that, is that basically taking any of the missed payment, re-amortizing it across, a new span of life of the loan to be able to recollect on those payments instead of a lump sum?
The servicer is going to provide a couple of different options regarding the loan modification. They may give you the option to pay up part of it and then have the remaining part of it added to the end of the term. If you don't have the ability to do that, they may just put it out to the end. depending upon your situation, I would say that a majority of them are going to be just re-amortizing based upon the current interest rate. Depending upon special circumstances, you may be able to get a lower interest rate. Again, every single person's scenario is going to be different.
So, Robert, when people are trying to figure out if they are even eligible for deferrals or a modification, I'm sure there's got to be some sort of standard that you have to prove that you're in some sort of financial strain, much like when you're in a short sale, you have to prove, that you financially are unable to bear, these things. It's not just willy nilly anybody call in because they don't want to pay their mortgage payment, right? I mean, there's got to be some overarching regulation over this. Is that ever evolving right now? What's happening with that?
It is in the process of changing because, again, Congress just wanted to put out something as quickly as possible in order to provide guidance to the servicers. But unfortunately, in their haste, they did not provide a lot of specifics with that. And so they really are leaving it up to the individual servicers to be able to make that determination. But what we've seen in the past is that you do have to provide documentation, typically showing some sort of financial hardship, a termination letter, um, again, something in writing from your previous employer confirming that your hours have been decreased.
Mm-hmm.
If you're self-employed and your business relies a lot on face-to-face interaction, providing any documentation, writing down a detailed synopsis of what your occupation is, where you derive your income is, and again, any supporting documentation. It's like making a legal argument that my income has gone down and here's my proof for that, and then that's what you supply to the servicer. And I would recommend to anyone out there, please, again, err on the side of caution. Talk with your mortgage servicer, see what they're requiring, and if anything does change with your financial situation where you do start working again, make sure your mortgage servicer knows if you are in a forbearance, so that way they can take the proper steps of what is available at that time to assist you.
Even this solution as a start is better than nothing. So hopefully it will all go well and be used as it's supposed to be used.
That's what we're hoping.
That's what we're hoping. Well, Robert, I want to thank you so much for joining me today and for your time and for your knowledge and your insight. Again, Robert Barnett here with Loan Depot in Tallahassee, Florida. He's got 17 years of experience, and as you can see, he's very well informed and educated, and it's a pleasure to work with him. So I appreciate having you on my team for my customers, Robert. Thank you.
Thank you for the invite, Sarah. I'm glad to do it.